Masterclass. This is session number 7. I remain your man, Ikenna Ume Izudike, Director of Modesty Financial Consultants Limited, based in Luton, United Kingdom. Providers of quality, customer-focused mortgage advice, financial consulting needs, and business loans and business finance. So this is another Wednesday, and this is another opportunity for us to talk mortgages and for us to gain some insights, some knowledge, some enlightenment around the world of mortgages and around the industry, the mortgage industry, especially in this uncertain time and in this unprecedented moment that we live in, where everything appears to be turned upside down. It's very important that we keep you up to date with things happening in the mortgage industry, so that you know exactly what button you need to press if you haven't pressed any yet, and what button you don't need to press in case you need to press any. So I hope you all had a very good Easter holiday. I did. I enjoyed a quality family time with my family. Yes, we are in a lockdown situation where we're all forced to stay indoors. So the holiday was like a compulsory one for everyone. But I hope you still found a way of making the most of it and enjoying that quality family time and that special celebration called Easter. So welcome back from the Easter holiday and from the Easter celebration. We're back onto our normal routine. Right, so today in this session, we're going to continue from where we stopped last session. We've been talking about mortgage products in terms of interest rate options. But before we jump straight into today's topic, we are going to bring you up to date with what's been going on in the mortgage industry and the mortgage market, some market updates, so that you know exactly what's happening in these unprecedented times. So first of all, there has been a survey carried out by a company called Really Moving. They're a comparison company for home movers. Companies that help people move home. If you want to compare which company is in your area, who offers the best service and all that, Really Moving a comparison website for that. So they carried out a survey and just to find out what people's behavior are like towards moving and towards completing deals, property purchase deals that they either have started or they're in the middle of it, or they wanted to do before this lockdown situation. So the result of that survey revealed that 62% of people who are in the middle of their house buying process still want to complete that house purchase process as soon as possible. 62% of people who are in the middle of their house purchasing process, they want to complete it as soon as possible. Meanwhile, about 75% of people who were planning to move homes still want to do that as quickly as they can, as soon as the lockdown is over, or as quickly as they can, even during this lockdown. Also, we found out that the main reason people were under 7% of buyers and sellers were people who were not willing to go ahead or who wanted to pull out of a deal. And within this very small percentage of people who were not willing to continue with the deal or to pull out of the deal, some of the main concerns they had were towards the UK economy. They were concerned about job losses. They were concerned about redundancy. They were concerned about house prices and what the house pricing is going to look like. But then 92% of sellers who have their houses listed for sale still want to leave it listed for sale even during the lockdown, because they want to take advantage of people who are browsing during this lockdown and who are looking for homes to buy, even though they cannot conduct physical face-to-face viewings, but at least they just want to make sure that their houses are safe. So they are not like withdrawing that house from the market. They still want to leave it listed and let people keep viewing and looking at it online. So it means that they are still keen to sell the property. Okay, and then buyers who are keen to complete and movers that are keen to carry on with their home moves is an indication of the fact that the demand is still there. even though demand was very high before this lockdown or before the coronavirus pandemic, but it shows that the demand is still there because people are still willing to complete on deals they have already started, and people are still keen to move home as soon as possible. It simply means that maybe it's an indication that after this lockdown, there will be, a host of activities going on in the properties industry, in the properties market, and people will still want to do stuff. So it's maybe an indication that the demand is still there. The demand hasn't wavered, it hasn't disappeared. People are just waiting for the lockdown to be over, and things might just may just be an indication of that from this survey. So because demand before lockdown was really high. Okay, the other thing that has happened in the mortgage industry is, when the government announced the payment holidays or mortgage holidays for up to 3 months for landlords and for homeowners, people wanted to take advantage of that. And some of us might be asking, what's going on? What's that situation like in the market? So the information reaching us is that about 1.2 million people have already taken, about 1.2 million mortgage product holders have taken advantage of that mortgage holiday. About 1.2 million mortgages have taken, availed themselves of the opportunity of that 3 months mortgage holiday. So what this really means is that on average, the lenders are offering about 61,000 mortgage holidays every single day on average, just in the last 2 weeks up to the 8th of April 2020. So that's basically where the lenders are focusing most of their resources and most of their capacity now and their capabilities, focused on basically making sure that their existing customers, their existing borrowers are well looked after, especially those who are struggling to pay their mortgages. So the mortgage payment holiday is just a deferment of the mortgages for at least 3 months. It doesn't mean you're not going to pay it, but you just defer it for at least 3 months until the end of May, and then people will now see, the lenders and the borrowers will now discuss how they intend to pay that off later on after that. But the thing is, mortgage holiday is not the only option available for you if you are struggling to pay your mortgage. There are other schemes, there are other options available for you. You can discuss with your mortgage lenders to see what options are available for you. Mortgage holiday may not be the best option for you. So talk to your lender and they will tell you the options that are available and which one best suits your individual circumstances, just to make sure that you're getting the best support and best help that you want, that you need, and that is available for you from your lender. So it's very important to do that. So the payment holiday amounts to about, on average, amounts about £260 per month of deferred interest for the average mortgage holder in the UK. That's that's the average amount of interest that is deferred for the average mortgage holder in the UK, about £260 deferred. So that's what the mortgage holiday average looks like at the moment. So an insight into the mortgage holiday is simply saying that, okay, you can't afford to pay it now. We're going to extend that. Either the lender extends your mortgage term by another 3 months, or they spread the costs of the deferred mortgages across the remaining terms of your mortgage. You may have, that means you have to pay slightly a little bit more than you normally pay on your mortgage monthly payments when the lockdown is over, everything returns to normal. But hey, that's a discussion, that's a conversation that you can have with your lender. They will tell you what's the best options are for you after the lockdown. Okay, so that's about updates on what's going on in the mortgage market at this moment in time. So let's dive straight into today's topic. So we are still discussing the mortgage products as far as interest rate options are concerned. And today we're going to be talking about flexible mortgages, and we're going to be talking about offset mortgages. Now, flexible mortgages, flexible mortgages don't have any particular definition. There's no particular definition for flexible mortgages, but it's accepted that they have, the following attributes. Number one is that the interests are calculated on daily basis on flexible mortgage, just like many other mortgage products that have their interest calculated on daily basis. One of the attributes of flexible mortgage. Now, I want to throw a little bit more light on daily calculation of interest and the implication. What it means is that any money you pay on any day into your mortgage account, from that moment in time, it reduces your mortgage balance and it automatically affects the level of interest you're paying. So it reduces the amount of interest payable on your mortgage balance from the moment that money hits your account, because the interest is calculated on daily basis. So if you pay money into your account on daily basis on a mortgage, your interest reduces on daily basis. So it's no longer a case of you pay money in January, the interest, it doesn't affect the interest you pay on your outstanding balance doesn't affect you until the end of the year. And other, it's not an annual interest. That's the implication of daily calculation of interest rates. In that, if you pay any money into your account, from the date you pay that money into your account, it affects your interest rate from that moment in time until you make another payment. Okay, so it's one of the attributes of flexible mortgages, just like many other mortgage products in the market. In fact, most of the mortgage products in the market these days are calculated on daily basis. The interest rates. Okay, overpayment facility. There is an flexible mortgages offers you overpayment facility, which means you can actually pay more than what you are meant to pay on monthly basis into that mortgage account. And what it does is that it reduces the outstanding mortgage balance. But that overpayment facility comes with some restrictions. As long as you are within the restricted maximum amount that the lender allows you to pay in every year, there's a yearly limit, for overpayment. So if the lender allows you to pay in within that limit, make sure you're within that limit. If you exceed that limit, some lenders will charge you early repayment charges on those overpayments. So the flexible mortgages, some of them have got overpayment facilities where you can make more than the required amount of payments into your mortgage account without incurring any penalties. There is also underpayment facility, available for flexible mortgages, which means that you can actually pay less than what your monthly mortgage payments are. Okay. Now, also, this comes with some kind of restriction as well. I'm going to come to one of the conditions under which you can make underpayments into your flexible mortgage account. And then there's also a payment holiday facility. We just talked about payment holidays now. It's simply a situation where your lender allows you not to pay anything into your mortgage account for a specified period of time due to certain circumstances. But in this case, you have to earn it, before you are granted that privilege of a payment holiday. Okay, and then portability is another feature of flexible mortgage. What do you mean by portability? It simply means that your mortgage is portable. You can actually move your mortgage product the way it is from one property to another. So if you're buying another property or if you're moving to another property, you can actually move that mortgage product and transfer it to the other property you want to buy. That's what we call a portable mortgage. Portability is a feature of a flexible mortgage. As long as the loan amount is within as long as the loan amount is within the outstanding loan amount of what you're owing, it doesn't exceed it. If it exceeds what you're already owing, you can't actually, port it. You have to apply maybe for another mortgage or, some kind of top up, but you cannot port the same product if it is more than what you're currently owing. But as long as it's within the range of what you're currently owing, you can basically lift that mortgage product the way it is and then take it to the next property that you want to buy. Also, so in terms of underpayment and overpayment and payment holidays, there's basically a condition attached to it. You've got to earn it. For one of the things you've got to do to earn is that your mortgage accounts must be in credit. meaning that you must have overpaid, into that your mortgage account at some point in the past, so that you can now take advantage of that overpayment and basically say, okay, I at this moment in time, I'm not where I'm supposed to be financially. Can I pay less than what I used to pay because there is already credit in my mortgage account, right? Because you made some overpayment. So the mortgage holiday the lender will give to you, or the underpayment facility that you're going to take advantage of, will be based on whether your mortgage account is in credit or not. So you must have overpaid at some point in the past, and then you can now, based on that overpayment you made, the lender can agree to let you off some monthly payments for some time, or let you pay less than what you normally pay because there is already credit on your mortgage account. So that's how you earn that on flexible mortgages. Now, flexible mortgages do have some flexible mortgages do have what we call drawdown facilities. That's another feature of flexible mortgage, drawdown facilities. Now, what do I mean by a drawdown facility? How does it work? Now, the drawdown facilities, how it works is simply um, you you arrange a maximum amount of borrowing with the lender, say 75% loan to value. So, for example, if the property is worth £100,000, and the lender says the maximum we can lend you is £75,000. So, at the initial drawdown, you might be buying a property that is worth less than £75,000. So you've arranged that facility with the lender at £75,000, but you need £50,000 to complete the purchase of your property. You draw down on that facility for £50,000, leaving a balance of £25,000 in that mortgage account. So this drawdown facility, which is a feature of the flexible mortgage, now allows you to come back on a later date, at a later time, and say to them, okay, I've got £25,000 left in my mortgage account balance, which I didn't take initially. Can I have, let's say, £10,000 out of it now? Maybe you need to do some home improvements, you need money to buy a new car, you need to do something. You can just go and draw down on that facility. That's what the drawdown facility offers you. But this used to be very easy. It used to be very simple to do it by just filling a drawdown form in the past. But since after the financial crisis and regulations became very strict and more and tighter, lenders have built some kind of fence around this kind of facility. What happens now is, if you take that initial amount and you don't take everything at that initial stage, if you come back to draw down on the balance of the mortgage on a later date, the lender might decide to run another affordability check on you, just to make sure that you can still afford that extra money you want to draw down from that mortgage. Yes, they've approved it for you then based on your current circumstances then. But when you come back, say 6 months down the line, or 1 or 2 years down the line, to say I want to draw down on that remaining fund, your circumstances might have changed. They want to be sure that you can still afford it. So they might run another affordability check on you before they allow you to draw down on that. So that's basically one of the conditions surrounding that at the moment. The other attribute of this flexible mortgage is what we call the current account mortgage. Now, how does the current account mortgage work? Now, the current account mortgage runs like your normal current bank account. Yeah. So you have this mortgage account. It allows you to actually receive your salaries and your wages into your mortgage account. All right. And then you can also pay direct debits and standing orders from your mortgage accounts. That's how current account mortgages work. So the advantage there is that when you receive salaries and wages into your mortgage account, every credit that comes into that account reduces the mortgage balance. And as it reduces the mortgage balance, it reduces the interest payable on that mortgage. You can actually be spending money out of that mortgage account as if it's your normal bank account. Some lenders will even give you checkbooks on that. Some lenders might even give you credit cards or debit cards on that. So you run it like your normal current account. But the difference then is that every credit, because the interest is calculated on daily basis, any day you receive credits into that account, it automatically reduces the outstanding mortgage balance. Therefore, it reduces your outstanding your interest. So what then happens is it wouldn't reduce how much you're paying every month. Your monthly mortgage payment will remain the same. But when each time you make that monthly mortgage payment, because your mortgage balance has reduced and it has reduced your interest rate, it then results into overpayment. So that overpayment you are now making, because your mortgage payment remains the same every month, and your interest element of that mortgage payment has reduced. So the whatever you pay there becomes an overpayment, and that overpayment now goes further to reduce the mortgage balance, upon which the interest will be calculated the next interest period. So by so doing, you are more likely to pay your mortgage off earlier if you continue to credit that account on regular basis, and it continues reducing that. You might find out that you can pay that mortgage off earlier than you would have normally done. Okay, so let's talk about offset mortgage. Yeah, offset mortgage is a very popular one now, and a lot of lenders are really, ramping up the publicity and the marketing of offset mortgages. So what does offset mortgage, how does it work? Offset mortgages, they are a little bit similar to flexible mortgages. But the major difference is that the mortgage and the savings account of the borrower are held in linked accounts. So your mortgage account and your savings account as a borrower, they are held in linked accounts. Now, the savings that are held in those linked accounts are used to offset your mortgage. That's why it's called an offset mortgage. So your savings on one hand, your mortgage account on the other hand, but there is a link between the two of them. Your savings on that one hand is used to offset your mortgage on the other hand. Now, when we say it offsets your mortgage, what it means that you forgo the interest on your savings account as long as you're using it to offset your mortgage. That interest you have forgone on your savings account will now be put towards paying off your mortgage on the other hand. Okay, so you don't earn any interest on your savings account, but the money in that savings account will now be used towards offsetting your mortgage. It reduces your mortgage balance. Therefore, the interest payable on your mortgage will now reduce. But the opportunity cost of doing that is losing out on the interest you're supposed to be earning on your savings account. Now, that's the savings that is in your savings account. You can take it at any time when you want. It doesn't mean that you have to keep it there and hold it there. If you want to take your savings, you can take it at any time. But just know that when you take the savings out there, the mortgage balance is just like a pendulum. When you take the savings out, the mortgage balance, kind of increases, and then the interest rate payable there returns to almost what it used to be, but it kind of reduces. But when you add to the savings account grows and the mortgage balance reduces. That's where the balance is. The savings account will weigh down the mortgage balance. The more you have on that savings account, the lower the mortgage balance goes. And as the mortgage balance reduces, the interest payable on it reduces. Now, your monthly mortgage payments will remain the same, but the interest element in it will now be less, which means it will now result into overpayments. Okay. Now I'm gonna illustrate that. I'm going to illustrate it with very straightforward numbers for you to understand. Say, for example, you have £100,000 mortgage, right? And then you have a £25,000 savings. Okay, so that £25,000 savings, maybe it was supposed to be yielding you, say, 2% every year. That 2% of 25,000 is £500. So every year, so every month you should be expecting like £40 interest every month. So that £40 that you should be receiving in interest every month, you have forgone it. But then your mortgage of £100,000 is at 5% interest rate. So 5% interest is about £5,000 every year, which maybe is £400 every month, thereabouts. Yeah. So what happens is when that £25,000 that you have in your savings account, in your mortgage balance, instead of showing £100,000, it will now show £75,000. That is the offsetting. So they've used your mortgage, your savings account to offset your mortgage. And now your mortgage balance, instead of showing £100,000, is now showing £75,000 because you have a £25,000 savings. Now the interest payable on £75,000 obviously is lower than the interest payable on £100,000. You can see how it reduces your interest rate. So still at that 5% interest rate, it then means instead of £5,000 annual interest, it's now like £3,750. Yeah, and then on monthly basis now you should be paying about 300 pounds every month. Yeah, monthly interest. And then that £300 monthly interest, that's so when you pay your mortgage, as when your mortgage is now £500. Okay, the interest element should have been £400 if there was no savings. But now the interest element of that is now £300, but you're still paying £500. Okay, so it then means that you are making an overpayment of of £200, yeah, into your mortgage account, and it then reduces. As it reduces that balance, the next month it reduces it again, the next month it reduces it again, as long as that savings balance remains the same or it keeps increasing. So this actually helps you pay off your mortgage quicker. If you have a savings account, it then means that as you continuously reduce the interest payable on that, your savings is actually working harder for you. Because what it means is that instead of earning 2% on those savings, you are earning 5% on the savings, because the savings and the interest is now based on the mortgage interest. So you are now earning 5% on that £25,000 in your mortgage. But the difference is that you're not receiving that interest in your account. That interest is used to pay off your mortgage and is calculated as an overpayment. And as that overpayment carries over into the next month and the next month, the multiplier effect of the reduction of that interest means that you will end up paying that mortgage off, quicker. Now, especially in this time when interest rates are really, really poor. In fact, the other time, we just received a letter from our savings providers, myself and my wife. Because the base rate has reduced to 0.1%. The bank, the interest on the savings account that we had, they wrote us a letter to say it's dropping from 0.75% to 0.1%. Okay, so that's basically, if we have £1,000 in that savings account, at the end of the year we're going to be earning £10 on it. Is it worth it? No, it's not worth it. So except you have immediate needs for those funds, it's really not worth it holding a lot of cash in savings at the moment, because savings now are worthless. If your aim is to grow that money, it will never grow in a savings account. It's just to hold it there as an emergency fund when you need it on short-term basis. Explore other means of growing your money if you want to grow them, except you're holding that money for emergency fund. So imagine if that money, if you hold it in an offset mortgage account. So if you have a substantial or considerable amount of savings and you hold it in an offset mortgage account, and then your mortgage interest, say you're on a standard variable rate of interest, say it's 4.2%. So instead of earning 0.1% on the savings account, you can be earning 4.1% on that savings via your mortgage account, but you will not be receiving it. It will just be going towards paying off your mortgage. So as long as you keep that savings there, it's working harder for you, and you are using to pay off your mortgage, and you can actually pay off your mortgage earlier. So if you don't need those savings, if you don't need the money in that savings account anytime soon, it makes a lot of sense for you to explore the offset mortgage product. At this time when interest rates on savings are almost zero. It just doesn't make sense. But if you have an offset mortgage account now, this is, I mean, your savings are working a lot harder for you than you can ever imagine. So that's basically how the offset mortgage account works. Now, the only thing is that, based on the way this works, a lot of lenders are presenting the offset mortgage account as a product that is only suitable for people who are, at the higher level of financial sophistication or understanding, or who have, substantial amount of savings. But then every little helps. No matter how big or how small your savings are, if you have an offset, if you want to take advantage of the offset mortgage account, you can inquire from your lender and see, if you're within, if your circumstances permit you to basically switch to an offset mortgage account. If you have a savings that you do not need now, or if you want to pay off your mortgage quicker, if that's what you want to do, and you want to use your savings to do that, it makes a lot of sense to explore that. But find out first if your circumstances permit, or the terms and conditions of your mortgage product permits you to do that. Okay. Now, there are things I need you to consider when you are arranging, flexible mortgages or offset mortgages. Number one is that these flexibilities, they come at a price. Normally, some of these flexible mortgages, their interest rates are higher than the standard variable rate of some of the product providers. So you've got to check and compare if really if the features of this offset flexible mortgages are worth it for you. If you don't mind paying a little bit more than what the standard variable rates of these product providers are, you can explore that. But that's a decision you have to make based on your preferences and your priorities, and then talking to your broker, and your broker can arrange it for you based on their assessment of what your priorities are. Now, although now lenders are packaging some of these flexible mortgages into fixed, tracker, and discounted mortgages for an initial period. So it's not always based on standard variable rates. Now, there are very good, because of innovation and competition in the marketplace, there are very good flexible mortgage products that are either fixed or tracker mortgages or discounted mortgages. So check with the lender and check with your broker what's available before you make that decision. Now, despite the rapid increase in the demand for flexible mortgages, lenders generally consider these types of mortgages to be suitable for those at the higher end of the market in terms of financial sophistication, which is what I just mentioned with the offset mortgage. But then you can still explore it and see if it's something that tickles your fancy. So it is then fair for us to say that offset and flexible mortgages are not for everybody. So please seek financial advice and talk to your broker before you settle for any of those. All right, folks. So that's it for today's episode and today's session on mortgages. And I hope you've picked up one or two things about how mortgage products work and how the offset mortgage works and how the flexible mortgages work. Please get in touch with us at modestyfinancialconsultants.co.uk. If you need any more information, contact us, and I'll be on the other end of the phone speaking to you, answering your questions, and putting you through. And this video will be available on YouTube as well very shortly today, and you can subscribe to my YouTube channels to see other mortgage videos and videos on personal finance enlightenment programs that we have embarked on. It's really a content-packed YouTube channel that we've got. So subscribe to it and avail yourself of every content that we have uploaded there. Thank you very much, and please stay safe. Coronavirus, it's real, it affects, it kills. Please, I don't want to lose any of you. Thank you very much, and God bless.